Hello, welcome to ACCA F3 Financial Accounting. Today we'll be learning about sales tax. So what is sales tax exactly? Well, it is an indirect tax that is imposed on customers when they purchase goods or services. So what happens is that a supplier is going to sell goods to a customer, and they're going to charge at a certain price, including a tax amount. It could be 10% or 5% of the sales price. So what the customer will then do is pay the total amount to the supplier. So the supplier is the one who collects the tax from them. And then what happens next is that the supplier is going to pay the full tax amount that was collected to the tax authorities. That's why it's called indirect tax. Now we have two kinds of tax: input and output tax. The basic difference is the direction in which the goods are being purchased. So if we're incurring input tax, when we're talking about input tax, that means the sales tax is paid on goods bought by the company. However, if we're talking about output tax, this refers to the sales tax that is charged on goods sold. So if you know that's the direction of the goods that are being received, input means it's going inside the company, whereas output means the goods are going out of the company. So in certain scenarios, tax can be irrecoverable or recoverable. So what happens when tax is irrecoverable? Irrecoverable tax occurs when the sales trader is not registered for tax. So what it means is that they cannot recover the tax that they will have to pay or the tax that they are going to charge. So in this case, the double entry for this kind of sales trader is also going to be different. So let's say, for example, let's say the business purchases goods that had originally cost $600. And let's say there was a sales tax amount of $90. Okay, so basically what the business is going to have to pay is $690. Now, if you are a sales trader that is not registered, your double entry will look like this. So, firstly, we're going to have to record this as a purchase, and purchases are a debit entry. So we're going to debit the purchases account by the whole $690. And let's say this person or business bought the goods on credit. So if they bought it on credit, we're going to have to credit the trade payables account, or if they spend cash, then we're going to have to credit the cash account by $690. Now, what is the difference if the sales trader is in fact registered? Well, that means that they will have recoverable sales tax. So when a sales trader is registered and they are able to claim back the tax that is imposed on them, let's say in the same scenario where the goods cost $600 and there is a sales tax of $90. So basically in total, they're going to have to pay $690. And let's assume this is on credit. Okay, so again, we're going to open our double entries. Now, in here, we are going to debit the purchases account with only $600. Now, what happened to the tax amount? That is going to be recorded separately over here. So we're going to debit our sales tax account to show that we have incurred input tax of $90. And the final credit figure will be the trade payables account by $690. This reflects that we are going to owe the whole amount to our supplier. So the same thing will apply if we're incurring output tax. the basic double entry would be debit your trade receivables and credit your sales tax and credit your sales account. So always note that the sales tax figure is going to follow either the sales or the purchases, but only if you are a tax registered trader. Now, any tax that is left unpaid is going to be a liability to the company. Normally, it would be a short-term liability because they are going to have to pay the tax by next year. So any tax unpaid would be the difference between your input and output tax. And we have to see which one is greater to determine whether it will be a liability or an asset. Because in certain circumstances, tax claims or tax refunds that should be paid back to you from the tax authorities. In that case, it would be recognized as an asset. But if you're the one who is liable for paying the tax, it should be a liability. So let me show you an example of how a sales tax control account would basically look like. Here is what a sales tax control account would basically look like without any contents. So I'm going to use fake numbers. So for example, we have a credit purchase. For example, we have a credit purchase. So that means debit the purchases and debit the sales tax control account. The credit would be the trade payable. So that means because we're talking about the sales tax control account, we're going to debit it and say trade payables. This is to reflect the input tax. So I'm going to say $8,000, for example. Now, if we were going to have an output tax, that means it would be on the opposite side. So we're going to reflect by saying trade receivables, for example, $15,000. This is going to reflect my output tax. Okay, all you have to do is just remember the double entries. If we're going to have a sales, then the double entry should be debit trade receivable, credit sales, and credit the sales tax account. That's why it's on the credit side. So let's say now that we have paid some certain amount of tax. When we are going to pay the cash to the tax authorities, it's going to be debit the sales tax, credit the cash. So cash will be over here, and this is to reflect the payment to the authorities. So let's say, for example, it will be $7,000. Now both sides will balance, $15,000 and $15,000. That means we don't have any tax left to pay for. Let's take a look at this question. Alana is not registered for sales tax purposes. She has recently received an invoice for goods for resale, which cost $500 before sales tax, which is levied at 15%. The total value was therefore $575. What is the correct entry to be made in Alana's general ledger in respect of the invoice? Okay, so from this question itself, we should directly identify that she is not registered. So if a trader is not registered, that means we're going to have to include the sales tax amount in the purchase or selling price itself. So we're going to have to take the total value. So in that case, for Alana, she's going to have to debit purchases by $575, and let's take another look. It says she has recently received an invoice for goods for resale. So that means it's an invoice. She has not exactly paid for it yet. So we're going to assume that she has to pay to trade payables. So we're going to credit the trade payables account by also $575. Let's take a look at the next one. A sales tax registered business sells goods costing $200 plus sales tax at 17.5 on credit. So it says here that they sold goods on credit, so we're going to have a trade receivable as one of the entries. Which of the following entries correctly records this transaction? So originally this question is supposed to have some multiple choices, but I cropped them out. So let's try to create our own double entry figure. So their sales tax registered. That means we're going to have to separate the tax amount from the selling price. So let's get to our double entries. So if this is a sale, that means there should be two credits, one for the sales and one for the sales tax. And the debit entry should therefore be the trade receivable, the person who we are selling the goods to. Now the goods were sold for $200 plus a 17.5% of tax. So that means sales would be recording at the sales price figure, 200. Sales tax would be the 17.5% times 200. So that would be $35. Now, in total, we are going to bill the trade receivable $235. Now let's take a look at this one. Trade receivables and payables in the final accounts of a sales tax registered trader will appear as described by which of the following? A. Inclusive of sales tax in the SOFP. B. Exclusive of sales tax in the SOFP. The sales tax is deducted and added to the sales tax account in the SOFP. Sales tax does not appear in the SOFP because the business simply acts as a collector on behalf of the tax authorities. Well, let's try to figure this out. They're asking us, how are we going to record the trade receivables and payables in the final accounts, meaning in the final financial statements? So, should they be recorded with or without tax, or should they not be recorded at all? Well, we can eliminate option D directly because we know that they're still going to have to record for tax. So D is not an option. Sales tax is deducted and added to the sales tax account. Well, it depends though. Let's take a look. It says they are a sales tax registered trader. So that means the double entry will look like what we have described before. The double entry should look something like this if they are sales tax registered, meaning that they're going to create double entries that disclose the purchases and sales tax separately, but then when it comes to recording the trade payables final amount, it's going to include that sales tax amount itself. So as you can see here in my example, trade payables is charged at $690, meaning they are charged at the cost plus the sales tax amount. So the answer should be inclusive of sales tax. Now, the only case where it's exclusive of sales tax is when the trader is not sales tax registered. That means we can eliminate the other options and declare them incorrect. Now let's take a look at this question. Sales, including sales tax, amounted to $27,612.50, and purchases, excluding sales tax, amounted to $18,000. What is the balance on the sales tax account, assuming all items are subject to sales tax at 17.5%? Well, we know that this amount already has tax inside it, so we just need to extract the tax figure from this total figure. So we know that tax is 17.5. So this figure would be equal to 117.5% because it already has tax inside that total figure. Whereas for purchases, this 18,000 does not have tax yet. So all we need to do is take 17.5% out of the 18,000 to get our sales tax amount. So I'm going to demonstrate this in a sales tax control account. Okay, so here is the sales tax control account. So let's calculate the output sales tax first. Okay, so earlier the goods were sold for $27,612.50. Now this amount already has the tax, so we need to take only the tax amount out. So it's going to be 17.5 over 117.5. That should give us 4,112.50. Now if we're going to put it on the sales tax control account, output tax is on the credit side. So output tax, 4,112.50. Now let's look for the input sales tax. Earlier it was $18,000. So this does not have tax yet. So we just need to figure out how much of this is sales tax. So 17.5 over 100. So we should get $3,150. Now input is on the debit side. So we put it right over there. Now, the difference is what is going to be either our liability or asset. So in this case, the balance carried down will be the difference between the two. 4,112.50 minus 3,150. We should get 962.50 to balance both sides. And 4,000 112.50. So that means when we open the account next month, the opening balance will be 962.50, and that means we have a liability of sales tax of this amount. We have now come to the end of the chapter. Thank you for watching.